Hello, investors and traders, and welcome to the Midweek Market Report. I'm AJ Monte, and this is a 3-month daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. As you can see here, I have my lines on the chart, which are the forecasts that I had from last week. And that downside target on DIA is 437.55. Now, we might go a little bit higher towards the end of the week, but I think we will start to see some downturn in the market. And then in a couple of weeks, I'll be talking about the year-end rally, also known as the Santa Claus rally. That is a 7-day window where in the last 5 trading days of the year, including the first 2 trading days of the new year, we generally see a rally in the market across the board of about 1.4%. Now, when you have days like we've had recently, 1.4% doesn't sound like all that much, but the unfortunate thing is that people tend to jump in ahead of what is known as the Santa Claus rally, and they rally it up far beyond where it normally goes. And if that doesn't make sense, think about irrational exuberance back in the day when Alan Greenspan talked about that before the crash of 2000. We have an irrationally exuberant market where things are happening that are even hard to explain. Today is a typical day where, unfortunately, very sad news came out today that the CEO of United Health, Brian Thompson, was assassinated today. And crazy as it sounds, the market in that stock rallies over 1%. Sad, but true. This is the craziness that I'm talking about here. So with regard to the rational market that we're normally used to, it's totally irrational. I want to do a quick report on Bitcoin. Today, Bitcoin topped over 100,000 mark, and you can see that this is attributed to MSTR MicroStrategy still buying Bitcoin. And when you think that's crazy, a couple of weeks ago, I had my chart of the week, the quick chart in MicroStrategy, when I pointed out this big, massive bearish engulfing. We have an ABCD pattern forming here in the stock. And if we get any kind of a downturn from here, we'll have a C with a much lower D. There's open gaps in here. I'm just doing more or less a follow-up to my quick chart Tuesday charts that go out through ZeroHedge. I'll get to that in a moment. So DIA, while I think we could go up a little bit, I think we're eventually going to pull back to get that target hit at 437.55. Moving on to IWM, you can see that we still have a lower high, lower low today. And with that, we also have a little bit of a conflict there in that is a bullish harami. So I think IWM with the general markets might see a little bit of a rally towards the end of the week, bump its head against this resistance up here at 240, 248, and then eventually work its way down to that target of 233.20. So it's IWM. QQQ, tech sector is still on fire here. We had a gap up on higher volume. That would lead me to believe we're going to go a little bit higher and then eventually come back to fill this gap. I still have a longer-term downside target down there of 492.79. Look at the oscillator, the CCI, and the stochastic both in an overbought condition, with the CCI down here showing a negative divergence. Remember what that is. A negative divergence is when you have lower highs on the oscillator but higher price highs on the chart. That is very bearish. We normally see that, like we saw back here, see higher highs, but we had lower highs on the oscillator, and then we had that sell-off. So that is a leading indicator that should not be ignored. Again, downside target longer term is 492.79. Looking at SPY, we have, again, another gap up. We have a gap up on higher volume, so I think we could go a little bit higher towards the end of the week. Looking at the weekly chart on this one, you could see that we're still in an upward trend, but look at the negative divergences down here on the weekly CCI, and we have much higher price highs here. I will erase these lines to keep my chart clean, but I'm just displaying that for you so you know what to look for. We, again, generally see those negative divergences at tops or at points where we're expecting a pivot to form to the downside. Negative divergences obviously are negative. They're more bearish in nature. So you don't want to ignore those either. Looking at the VIX, here's the conflict. We have a bullish engulfing candle on the VIX. Now remember, I have that guarantee up here at 2020 that the gap will eventually fill. I'm absolutely positive, and that's why I can give that guarantee, because the VIX is not an equity. It's an oscillating index. It oscillates up and down within a range, so that will eventually fill. So keep that in mind, especially if you're trading the VIX in stocks like UVXY or VXX. You want to make sure that you keep these gaps in mind as target prices, because if it gets up to that level, you certainly don't want to be holding on with a winner trying to turn it into a loser. You don't want to do that. So those are excellent target points for those who are trading the VIX. But remember, the VIX is showing a bullish engulfing while the SPY is still showing bullish signals. And historically, again, these are inversely related. So when you see a bullish VIX, you expect the S&P to go down. We're not seeing that yet, but when they are working in sync, in other words, when they're both showing bullish signals, that tends to lead to more bearish outcomes. I'll leave that where it is, and I'll talk more about that on Friday. Speaking of which, the holiday season coming up, we normally have our rapid fire stock analysis session on Wednesdays. We will be having one today from 6 to 7 p.m. But because Christmas and New Year's falls on Wednesdays, we're going to be moving the rapid fire segments to Friday, December 20th and to Friday, the 27th of December. We're going ahead of the holiday so we don't skip anything and make sure that everyone gets the value that they're paying for in that membership. If you're interested in a free membership for 2 weeks, come on over. We have that 2-week special for 2 weeks. We don't require any credit cards. There's no obligation whatsoever. You get your enrollment. You hang around for 2 weeks, listen to our videos, listen to the recordings, participate on our webinars. You can ask questions. And if you don't like what you see, you move on. Nothing changes. But if you like what you see, then you can enroll. And we leave that up to you to decide. But most people do stick around. We're providing enormous value. Make sure that you are at least plugged into the ZeroHedge quick chart, because every Tuesday, as you can see here on ZeroHedge, I put out a very short 3-minute video on more or less the chart of the week. It goes out on Tuesdays, highlighting stocks that are overextended either way, up or down. And a lot of people are trading against us. If you click the notification bell at the very top of the YouTube channel here, you will be notified when this goes out, and you will get the video before the masses do. You'll get at least a 15-minute head start. I'm not trying to turn this into a meme trade at all, but connect the dots. As I always say, if you can get ahead of the masses and put the trade in before they do, you're most likely going to have that momentum carrying you to a higher level of profit. And that's what we're trying to do. We're creating the audience. We're building it out. Thank you so much for liking and sharing and commenting. We so much appreciate that, because it's your sharing that's helping us build the channel. We're approaching 12,000 subscribers on this channel. And while that may not seem like a lot for the big social media influencers, that certainly is a lot for those who are interested in charts. And we continue to build that audience out. Again, thank you for sharing and liking and doing all that great stuff that gets us on the algorithm. All right, that's it for this Wednesday. Have a good rest of the week, and I'll talk to you on Friday for the weekly market report. So long.